Welcome to the Cardinal Commentary for the Canadian Equity Portfolios. Even though the sudden collapse of Silicon Valley Bank and Signature Bank happened in the US, those kinds of headlines are impossible to ignore no matter where you live. The good news for Cardinal shareholders is experts believe the crisis will remain south of the border, and to a lesser extent in Switzerland. Portfolio manager Sheila Wilson-Cole says the regulatory environment for Canadian banks has been much stricter since the financial crisis of 2008.
We're in a much different spot today than we were in 2008. The regulations are certainly a lot tighter on both sides of the border in Canada and the US, and in Europe as well. They have a lot higher capital ratios, so that makes them more resilient and able to withstand some of the shocks to the system. And looking at our Canadian banks specifically, they're highly regulated. They do run their businesses on the conservative side, and then on the deposits, a lot of them are insured, whereas in states, some of the banks that failed, they weren't in that same position. U.S. banks that we hold, the larger ones, are actually seeing some inflows into deposits. So people are looking for a place to park their deposits where they see greater safety than in some of the smaller regional banks.
The Bank of Canada held its overnight rate steady in March. And while it's still too early to say rate hikes throughout North America are over, the Federal Reserve recently increased rates by 25 basis points, we believe the end is near. In fact, some experts speculate rates could start to fall before the end of the year. Canadian Tire has been a shining example of a company that performed well, pandemic or no pandemic. It was deemed an essential service 3 years ago, and its shelves are full of the products consumers need today as they undertake a wide variety of home improvement projects.
The one company that really has, I think, that really done very well going into the pandemic and coming out of it is Canadian Tire. It's had some pretty good performance this first quarter. I think it is an underrated retail company in Canada. It's unfortunate that it doesn't get the notoriety as some of the big retailers in the US. But Canadian Tire is probably one of my favorite stocks to have in the portfolio.
According to Canadian Tire's most recent results, its earnings per share were well ahead of what analysts expected. Same-store sales growth was up 11%, and there was strong growth across all of its banners, including its own Canadian Tire stores, Mark's, and SportChek. And just as importantly, Canadian Tire has continued to increase its dividend, which has more than quadrupled since 2012. Our strategy of investing in industry-leading dividend-paying companies continues to pay off. Over the last decade, the annual dividend income on a $1 million investment has grown from about $36,000 to more than $80,000. Our portfolios protected capital better than the benchmark during a challenging first 3 months of the year. But, more importantly, we continue to outperform when it really matters, over 5, 10, 15, 20, and 25 years. And here's the proof. If you had invested $500,000 in the Cardinal Canadian Equity Portfolios in 1997, it would be worth more than $12.5 million today, more than double the benchmark. And why do we do all this? Because it works. And that's the Cardinal Commentary for the Canadian Equity Portfolios. Thanks for joining us.